All right. Welcome back, everyone, to the episode of Chart Talk, first one of the new year. Jumping into it. Again, pretty quiet last few weeks. With the holidays, markets were very slow. It was like, kind of watching paint dry. For the most part, we did had, somewhat of a pretty nice snapback in the market coming into today. A lot of during Christmas, you had names moving a tenth of a percent. It was like, these inconsequential moves. And then today there was a, plethora of names up 5, 10%. So it really seemed like the volume and the buyers really kind of step back into the market, which is great to see. Again, broadly, S&P, the real out going into this year, if we're going to continue higher, this out doesn't matter. But if the market was to ever break down, this 650 area for now is the key out. Sure, we have this mini pivot low at 670, and even right now, this mini pivot low at 680, but these aren't as significant for short-term trading, and they're good spots to keep aware of. But really, if the market is ever going to break down this year, this 650 is going to be the line in the sand where it really confirms that, you know, the the bear market, the bull market we've been in is ending. For now, again, very long way from that. We more likely see a break of 690 to new highs than we're going to see this break of 650. But if we zoom out a little bit, I tried, highlighting this in the most recent newsletter. If we look back at some of the recent runs the market has been on. So if we go back to just 2020. So we had, bear market in 2020 with COVID, obviously. And from that market low, we had a 2-year rally. And in the last newsletter, I'm trying to highlight the starts of the year, is that there has been times where the market starts at all-time highs and it feels like the market has to crash because the market is at all-time highs, and it's hard to imagine it continuing that trend into the new year. So in 2021, we experienced that. The market had closed at all-time highs, but we still had an entire year of a pretty tight, bullish channel until the next year, 2022, where again, the market started the year at all-time highs. Now that year was much different than 2021. 2021, we were kind of a year post the COVID bottom, and the market still had another year in the tank before that top. Now, again, from December 31st to January 1st, there isn't really much of a change when it comes to the market, but just more human psychology. It's a new year and kind of everything gets reset. So 2022 was that second year of that bull market, the start of the year at all-time highs. And then we had that very difficult, if you guys were around for this, very difficult, pretty much entire year. Tech stocks were getting crushed. They were, the biggest leaders going into that COVID bottom, into that market top. They were getting destroyed. Market pulled back very slowly, very methodically. It did base out and climb back to highs, but 2022 was a very tough year overall. Now, 2023 also started the year basically at all-time highs and also went on another run for the entire year to new all-time highs. So we're seeing, 2-year run from market bottom to market top. We're seeing kind of like this 2022, 2024, another, 2-year run. And then we fast forward to today, 2025, we had, that tariff war, we had that 20% bear market, and we've had the very impressive rally off those lows, but we're still kind of early in the game. This is, it reminds me very much of this 2021 market. And we were talking about maybe, semis being overextended or overvalued. Valuation wise, as much as we don't care about valuations for the most part when it comes to swing trading, they're not really as crazy valuations compared to some of the tech names at those 2022 highs. So as much as I still feel that we see 800 in the SPY by year end, and that we follow more the trajectory of like the 21 to 22 market and 23 to 24, where we just continued that path higher in these very tight channels, we still want to talk about, if that doesn't happen. Here we have this tight channel, and then we kind of have the same one here, and expecting, kind of a similar one, for the next year. Now, if that is not to happen and my outlook is wrong, then the break of 650 would confirm that. And that's where, you can see each of these times when the highs were in for 2024, that break of support really confirmed when to step aside and avoid the next leg down. And same thing again. In hindsight, it's very easy, but the key thing here is the key break of support at these major market tops were not, the hardest things to spot here. We can see two very clear spots here where markets at all-time highs breaks that support area, breaks down. This was the time to move to the side. Same thing here. Market was at all-time highs. Once it broke support, it was time to get out. So 650 in the SPY, that is the real area that if this rally is to stop, it's going to show the signs that it's stopping with a break and close below 650. Until then, we probably see continuation of what we saw this past year, which is just that grind higher. So we know the downside. We know getting out below 650 is going to be the key sign. And for now, the path of least resistance seems to be higher. Buyers continue to step up, especially coming into the new week. Now, if you were, we don't really trade the SPY, but if you had to buy 690 versus 680, very tight risk trade versus trying to buy it, this time at the retest where your risk was, 30 points versus it being 10. So S&P looks great. Q's, you know, kind of hugging the support of this trend line that it's been in. But all we want to really see, is this break, through this like 630 area. But S&P is definitely taking the lead. And again, Dow 30 names, rocking and rolling in this breakout channel. They look great. So again, dollar's been pretty weak, pulling back into this range, all good signs. So moving on to some sectors. Again, financials were up 15% this year. We can see them testing this resistance area. So sure, there might be a little breakout and continuation tomorrow, given the strong action that we saw today, but resistance areas, are there for a reason. And this is, probably the area to be, kind of ringing the register if you've been in it. Semi is another one, new all-time highs. Looks great if you've been in for this run. Industrials, again, just like the Dow 30, nice bullish channel. Again, the key thing here is this is still a profit-taking area. This channel has held up all year. Industrials had a phenomenal year last year, up 17%, but this has been the channel. Anytime it's gone up here, this has been the time to take profits, even though, this is when they look the best. Again, small caps, going into the new year, small caps really haven't done much for the last couple of years. So what I was trying to articulate in the newsletter this weekend was last year's winners very rarely, sector-wise, are going to be this year's winners. They've already gone so much in the prior year. It's, sure they can continue it, but kind of the underdogs rotate and play catch up. So this IWM, again, S&P up, nearly 20% last year, Dow up 20%, NASDAQ up nearly 20%. Small caps, pretty much flat in the year. Consumer staples basically flat in the year. REITs flat in the year. These are the sectors or indexes that could potentially play some catch up and chart wise look phenomenal. So we have this little dotted area just showing the retest area, all-time highs back in 2022. 3 years later, they retest those highs. Again, the retest area often met with resistance. And then as you have those subsequent attempts down the road, those increase the likelihood of a breakout higher. So this is kind of like the new area it's chopping around in. This 230 to 250 area. And we're starting to get much tighter. Now this, retest area in the past that was resistance has started to act as support. So just giving us much tighter entries. Again, the measured move of this is like a move to like 320. If I'm wrong, the bear case is kind of a retest of the, Terra 4 lows, but I would be more inclined to see this breakout and push higher throughout the year than, seeing a retest of support. So small caps look great. Again, energy breaking out, with what's going on in Venezuela. You had kind of a mixed bag in energy space. Some sector, some names gapping up huge, some names gapping down huge, depending on their exposure to that space. But again, this is we're going back, same thing like small caps, 3, 4 year base. You zoom out even further, you go back to 2008, the financial crisis. This resistance area has acted like that resistance area for 20 plus years. Do I think the Venezuela thing is going to be the catalyst to push this out? Probably not. I think after a couple of weeks, I think the headlines are going to kind of die down and it's going to kind of go back to business as usual. But it's going to take a lot to really push the energy sector out of this nearly 20-year plus consolidation. When it does, the thing will be off to the races. But this has been setting up for many, many years, and it's hard to expect that one day's price action is going to dictate a 20-year breakout. So still keeping it on the radar, but a little cautious trying to buy this breakout, just given how long it's taken to set up. And again, a lot of other sectors. I'm not going to go through every single one, but again, notable ones: healthcare. Again, you know, retest that prior all-time high, flagging out in this new range. And at some point this year, we want to see that push through this 300 area for that move, up toward 330 and higher. Consumer discretionaries, another one, you know, chart-wise looks phenomenal. Didn't really have, much of a year, pretty much a flat year from where it opened, but setting up, for a textbook blue sky breakout through these all-time highs. And this is like a great candidate for, a technical laggard of 2025 based off what it returned, but it hovered basically near all-time highs for the second half of the year. So the overall return wasn't that great, but that's where if you're thinking if there's two sectors, one's up 30% and one's up 5 for the year ahead, the inclination for most is going to be taking profits in that winner, rotating back to the one that's a little more undervalued. So definitely keeping a close eye on consumer discretionaries, on healthcare, and small caps as well. Again, some of the weaker sectors, we have consumer staples, hasn't done much, broadly flagged out, basically flat on the year. And utilities, pulling into macro support. Again, pretty weak for the last month or two. We're not really trading utilities that much. Seeing weakness in utilities, good sign overall for the market. So we're not really losing much sleep over that one. Again, on the radar, we have this Gilead. Again, keeping a close eye on this breakout through all-time highs. Again, Gilead, very strong in the last year, very clear channel. We can zoom out, going back home, more than a decade. Gilead's finally getting back to all-time highs. Decade later, massive base. So, when these things get back, are able to push and close through all-time highs, these are the times we want to, keep a close eye on these names. So, this Gilead through that 129 area, great setup when the time comes. Going into today, we were keeping a very close eye on this Oracle, but it just was not ready. We can, name has definitely gotten a little beaten down from, the AI announcement, pretty much reversed the entire move. But after this breakdown stage, we saw this tight little flag starting to form. Definitely had some decent volume off the open, but just kind of faded. We took this through 200. Switch to like a 15-minute just for a moment. And we can see, all week, this name has just been flagging out in this range, it's $8, $10 range here. And as it kept getting up there, today has that gap up and pushes through, but quickly reverses. So when we were talking about this morning, if this was going to be the gap and go, this name should have never saw the low of day, which was 198. So we bought through 200, pushed, about $1.50 in our favor, but then quickly reversed, took out that low of day. And there was no reason to give this back verse, the 192 proper out because we're expecting a breakout. And if it's not breaking out, what are we doing? So took the little 1% loss, no big deal. Faded the rest of the day would have been, a little bit of a bigger of a loss if we stuck with it. So it definitely made sense getting out, just keeping risk very tight. And now we know 202 is really the spot. And really the goal of this trade was just to fill this gap to this like 215 area. So we took a $2 shot in it, didn't work. And now we just know 202 is the spot. This now can shake out, do whatever it needs to do. When it gets back to 202, that'll be the time to keep a closer eye on it. Again, just some big picture alerts from the past week. Again, this eBay continues. We had this nice support buyback through this 84. Now it's breaking, through the resistance area into this gap fill. So if you're still in eBay, looks phenomenal. Have that stop versus 80, 86 for now. Looks great. Again, Exxon, definitely gapping up on the Venezuela news. We were talking about this last week. Had no inside information about any dictators getting captured, but the chart, just didn't lie. And we can see that 120, which was resistance, for the better part of the year, has now quickly acted as support and pushing higher. So Exxon looks great. Again, this AAPL was another alert. Pretty crazy this how small this inside day was 2 days ago, but we did have the alert today through this 86. Crazy day at 15%. We'll see where this one can go. BYD, blue sky breakout, 388, doing great so far. Again, pivot low is this 84. You can see these multiple attempts, 5 attempts before it finally breaks. And, these are the times you want to get in when it's finally breaking, very tight risk, 2% risk here. And then probably a move here in the next couple of weeks to about this $100 mark. So looks good. And then we have this SoFi was getting pretty tight last week. We had that alert kick off today through 28 versus 26. So $2 risk here. Again, this SoFi we've been talking about for quite some time. Getting through those IPO highs. Finally, again, still kind of chopping around in this range. So wouldn't expect, smooth sailing through highs. But if this can get a move back to this 33 area, and you take some profits into that, definitely makes sense. And again, these are all alerts that are posted in real time. We had SMCI alert today. We had the Oracle off the open through 200. Wing was going through 260. SoFi through 28. BYD through 88. These are all alerts you can see coming through as they're approaching those breakout levels. So these are all things that we're alerted before the breakouts occur. So moving on to just some charts that are definitely in play, keeping an eye on. Again, silver, we are not trading silver, but just keeping a close eye on the run up it's had. Again, very similar, playing kind of catch up with what gold was doing a few months ago. Silver currently is kind of like in this chop. The easy run is over in silver in the short term. Now you kind of have the chop and the fade where it pulls back in and then, kind of dances around. And that's kind of what we're seeing in silver. Buying it up here after the 40% run up, you're just asking for trouble. Same with the people that were lining up to buy gold. We were seeing it all on social media. It was, this last part of the run up, no one was chasing to buy gold at the breakout level. They were all chasing it at the extended move when it had to go higher. And that's just where silver is at in this, the start of this flag. But this is it's the late, the buying up here is super late to the party. So would avoid this, at all cost. Going into tomorrow, this WST, been getting very tight here. We can see, these buyers stepping up over the past couple months, getting tighter and tighter. About $10 risk here for this tight little breakout. After hours, it's a little bit above 240, so we'll see if we can get that entry through 280 tomorrow. Again, not going to chase a gap up. If it opens under 280 and pushes through, that will be the trade. If not, it's a pass. Again, Amazon, I think for the new year is going to be, one of the FANG names to really keep a close eye on. Very nice consolidation here. Very clear all-time high breakout. And Right now, it's just kind of chopping around in very tight ranges. Really, 240 is the key spot. 220 is the key out for now. It's going to be hard to be, trading it in the middle or trying to be perfect. This is one to kind of slowly, get into or just wait for that 240 breakout. But among the FANG names, I think Amazon will probably be one of the better performers of the year. Again, QFIN, personally hate names that are under $30 a share, but sometimes there are some exceptions to the rule. QFIN is one of these Chinese companies. Again, some of these Chinese names have started to wake back up. You had Baidu up 15% the other day. So there's definitely some rotation back to some of these Chinese names. Very textbook base forming here, very tight range, buying 20, stop 19. Again, risking a dollar here. It's about 5% a name like this. But realistically, a move to this little gap fill area 22, you get about 10% move in the name. So keeping a close eye on it through this 20, not dying or salivating over it, but you know, this pattern has to go one of two ways. Either it's going to break through 20 or it's going to break through 19. And if it breaks through 20, the short-term move is at least to that 22 area. So keep an eye on that one. The CBRE, another blue sky breakout. Keep an eye on this 165 area versus this 159. Pivot low is about $1 higher than it was about a week ago. So keep an eye on this. Next up, we have this tree. Again, financial names have been pretty strong. This tree here, just starting to keep it on the radar. A little support buyback through this 56 versus this 52. So keeping this one on the radar, for a move back to like the 65 area. And then wrapping up the last few names here. Again, we have this BMA, another financial name. Again, financials very, very strong lately. And we can see this nice, earnings flag that's been forming for a little bit of time now. So keeping on this 94, we can see, the beginning of this earnings gap up, how wide the range was. As months go on, it starts to get a little bit tighter, and get tighter. So that's the overall theme with a lot of the trades we take is we wanted to see very tight consolidation, very defined resistance levels, and very defined areas of support. Very black and white. So anxious through 94, stop for now versus 86. Again, don't think it's going to go tomorrow, but just keeping a closer eye on it for that eventual break. And then last but not least, PFSI, another financial name. It's been very strong lately. Just flagging out here near all-time highs, keeping it on this 135. Again, a few months ago, $13 range, $9 range, $5 range. So we can see, the buyers continue to step up, support the stock. We have clear sellers at this 135, and we just want to see this level break. So risking $5 here, all-time high breakout, and we have until end of the month till earnings, so plenty of time for that one. So overall, again, keeping it very selective, keeping risk very tight. Again, index looks phenomenal. Looks like we can definitely see a breakthrough 690, and we have a very tight pivot low if that isn't going to be the case. But for now, really the key out is 650 in the SPY. So I do think we see, 800 in the S&P by end of year. I do think this is like a realistic target. Again, for now, we got a really clear 700 each. Whole round number is going to act as psychological resistance. So 700 in the S&P, 800 in the S&P, 900, 1,000. These are all going to be kind of magnet areas of where resistance is going to get created. So we still have to get through 700 before we can get to 800. So we don't get too ahead of ourselves, but we know the key outs, we know the key entries, and then just finding those tighter setups as the weeks progress. So any top ideas you have, you can always post them in the comments below, and we'll go over them next week.